Hey everybody, and welcome back to another video. Sorry for the long hiatus. I was visiting some family for Thanksgiving. And thank you again for tuning in if you have. But let's get right into the video. This one's going to be another update video on Chewy stock. Boy, the stock market has been in absolute free fall since I've been away. Just all of the indices falling day by day. Most of them are falling by multiple percentage points, 2.5%, 1.5% each day. And we've had a lot of good deals in the market. So I'm going to be analyzing lots of stocks because lots of stocks have piqued my interest recently. So lots of ideas for videos. And this one is going to be just an update on kind of where I am with Chewy stock. And what I'm thinking about it, is it time to hop back in? Is it time to buy the dip on this? But as always, we typically start with the market capitalization on this channel, and it is a $25 billion market cap for this stock. The stock price is just under $60, and it has been almost in free fall since February. We can see that it reached 118 on the quick chart. I think if you go to the more detailed full screen chart, you would see it hit over 20. So this stock has fallen over 50% from its highs, which is quite substantial. If we look at the quick PE, I think this is the trailing for it. It's a 2,600, which is obviously much higher than any other stock on the stock market that is currently making money. But if we go over to the stats, we can see that their forward PE is actually much lower, a little bit more reasonable at 212, which is still quite high, still about 10 times the average of the S&P, which is around 20 to 25 currently, since the market has sold off. It was around 25 to 30 just a couple months ago, but as valuations have been compressed due to interest rate scares being raised in the future, which is a big reason why this stock has fallen so much, just because they do have a very high valuation. And like I was saying, since interest rates are likely to increase over the next coming years, the highest valuation stocks do get hurt the most when interest rates do get increased. If we take a look at their just a lot of their stats and their balance sheet, we can see right off the bat their profitability and their profit margins are very paper thin, almost non-existent. They have less than 1% for both the margin and operating margin. This is not uncommon for a e-commerce company to have low margins, but these are extremely low for low margins. Typically, Amazon will have closer to 10% on the operating margin, and their profit margin, even in the single digits, but much higher than this. If we look at their income, they are earning quite a bit of money for the early stage growth company that they are. If we go back to their market cap, it is intraday 26, but it was just about 25 billion today. And they're earning for the past 6 months of 2021, they've earned $8 billion, which is a good amount. So if we go to the price to sales, they're honestly not that expensive for an early stage growth company. A 3 is still very high compared to typical stocks in other indices, such as the S&P and maybe the Russell 2000. But this company is looking to grow quite substantially, but isn't quite reflected on this report here on Yahoo. If we look here, they've only grown year over year 26%, and for a price to earnings of 200, I don't know if I could warrant that, just because a lot of companies will grow triple digits percents and still have a lower price to earnings. So there's just a bit to be desired there. And they are currently starting to make a profit, though we see very slim ones. They had a gross profit of just under $2 billion, so almost $1 billion a quarter, which is pretty good for this company. Anytime that an early stage company is able to earn money on the bottom line, that's something that I can get behind and respect, because I always emphasize in my videos that's what you're investing for, a company that makes a return on your capital, and that will usually always be appreciated in the stock price over time, as long as we are either in a bull market or there are buyers for the stock. If we look at their balance sheet, just for their cash versus debt, they don't really have a lot of cash for the size of the company that they are. They're a $25 billion company, and they have less than $1 billion of cash on their balance sheet, which is a little worrying, just because if they wanted to make any acquisitions or really grow the company and try to expand their margins by reinvesting into the company, they really can't, especially because they do have a good amount of debt, just about $400 million. And they are very easily able to pay all of this off, but if they were to, they don't really have much cash on hand to do substantial moves to just reinvent and reinforce their company for the growing years. So that was just kind of a red flag for me, just the lack of cash and the good amount of debt on their balance sheet. If we look at the last thing I wanted to point out for the stats is this stock is very coveted, and you can see that on the market. There is quite amount of interest in people buying this, whether that being for short or long. So 20% of the company is still held within people still for the company that still work there, which is very, very high for a company that has shot up so far. This stock, we look at what it started at when it first came to the market. This stock was around $30, and it shot all the way up to $120. So most people would assume if you have that substantial of a gain that you would take a good amount of profits, especially if you have quite a bit of stock in this company, as most people who worked for the company early on would have. So that is just a bullish sign, so that it proves that the people in the company have just a reason to work as hard as possible. Also, there is a substantial amount of interest from institutions. We can see that 88% of this is held by institutions, which, if you add those up, those are obviously over 100%, which does happen quite frequently in the stock market. A stock will be held by more than 100%. Well, a stock will have more than 100% of its shares purchased, which may be a little confusing, but this mostly has to do with the shares short, because companies have to offer shares for people to not only long the stock but short the stock, and we can see that it also has quite a bit of short percentage. So it has 22% of short percentage, 88% of institutions, and also 20% held by insiders. So there's just a big battle going on between mostly these two groups fighting against the shorts, because 20% is a substantial amount of short percentage. If you guys have watched any of my videos before, I would consider anything over 5 a good amount of short percentage, because if a stock is genuinely accepted as, you know, a unicorn and a very good long-term growth stock, people aren't going to want to short it, and they just want to go long the stock and trade long options. And people, it's just not something that people would want to do or could do, because they know that they would lose money. So this is obviously just a more heavily debated stock, and people don't really know what it is valued and what people truly want to pay for it. And that's expressed by the high short percentage and then the high interest by just a lot of big money. So that's kind of what I wanted to share. And due to the over 100% interest, this causes very, very drastic moves in the stock price, and rapid too. So if we look at the stock chart just for the technicals, we can see here that the stock moves very, very drastically and rapid anytime there is a move up or down. It is very, very volatile, and that's due to the just amount of interest in the stock, because anytime that there are buyers, there's already such high demand for the stock, there's very, very low supply. So then when demand does come in, it shoots the stock price all the way up. And then when demand finally dries up, there's always people trying to short this stock, so it just drives the stock all the way back down. So it's very, very buyer driven, and when the buyers come in, the stock shoots straight up, as we see all the way from 2020. It went from a low of $22 all the way up to 120, so over a 5x, which is just phenomenal. And then went from 120 all the way down to 60. It went from 60 all the way back up to 90, almost 100, and then all the way from 95 all the way back down to 59 today. I made a video back on October 13th, and that was these three lines that I drew. I kind of drew a range for the stock, and I said that, oh, I didn't mean to do that. Let's go to drawings and undo that. Yeah, we'll just leave it there. Whoops, didn't mean to do that either. Sorry, we'll go back. But I drew this range here, and this was kind of a little bit of consolidation that I saw back from October of the year before, and I said that we could see some consolidation or a bounce off of this line, because we had started to see a bit of a reversal, and the stock was trying to push above some of its moving averages at that point in time. And I made a video saying that this could be an intriguing entry position if you wanted to get into this stock, which I personally was not, and I, just for the record, do not have a position in the stock as of yet, and I'm not currently planning on it. And then I said, if it does fall below that line, then it will be a very intriguing buying opportunity, just because I did see a good amount of consolidation between this range. We can see here it's almost a straight line for 2 months, and then a straight line for another 2 months here. So then that's where I drew the channel for the stock to fall into. And I said that if it falls below here and we see some consolidation, then it could be an intriguing buying opportunity if you are looking to get into this stock, or an e-commerce play if you don't have exposure to it. But since then, the stock has fallen dramatically again, like I said, from 95, and I added 2 more lines. We saw a very, very supported downtrend from these 3 peaks, kind of bull traps, where people thought this was going to take off again, and whether it be market-wide, just fear and uncertainty due to other strains of the COVID, or just uncertainty due to interest rates, whatever it may be, we have seen a failure to break out, and these have ended up being bull traps. But we can see a very, very clear downtrend here. So I drew a line there, and for the second line, I was drawing the uptrend from the low of March of 2020. And since you can't really accurately draw the uptrend since then, because, I mean, this stock is falling quite dramatically currently, and it went straight up for a good period of time, I intersected it with the clear downtrend that we do have, just to try and have some clarity. And my general thoughts were that if this stock does continue to consolidate within this channel, then it could be a good buying opportunity, just because that would mean that there is buying pressure within the stock again, and people are interested in taking a risk on buying the stock. But if it falls below both of these lines, past this range, I would say that if you do have a position, I would probably sell out, because it could have further room to the downside. But even if you don't, you might want to stay away, because it's very, very well below its 200-day moving average, and it's just very, very hard to awake a sleeping beast, as they say in the stock market. If the stock's been on a very, very, very ferocious downtrend, then it takes a really large or big amounts of catalyst to get the stock moving in the upward direction again. So that was kind of my general thoughts on what I saw when I looked at the stock chart, and what I think what people are doing with the stock in general, and when and where they want to buy it and what price. The last thing that I want to touch on is that they do have earnings coming up, which could be a positive catalyst for the stock. This is on December 9th, which is coming up very, very shortly. And then just looking at some of the articles on Webull, there is one thing that I want to point out, that they're from Wedbush, which is a very renowned analyst for individual stocks and the market, risks that there could be a good amount of churn on the stock, which is essentially a good amount of people choosing to not renew their subscriptions for Chewy. Whether this be they feel more comfortable going out back to the stores, just because a lot of people did sign up during COVID, and now that you can go back out and people feel a little bit more comfortable, they could be losing a lot of business. Other people could be going to other online providers, because I believe that the space could be heating up, such as Amazon, or maybe they just thought it was too expensive and would rather get it in the store, and they don't even care about COVID, and that's not something that's crossing their mind. So those are three general factors that could be a risk to this stock as well. But if you made it this far into the video, thank you very much for watching, and have a great day.